Welcome, everybody. So glad you're able to join us today for HdL's latest sales tax trends and economic forecast webinar. Before we get started, I just want to let everybody know the presentation is being recorded and will be available along with the slide deck on HdL's website, hdlcompanies.com, and also our YouTube channel very soon. All registered participants will receive an email notification as soon as the documents are posted. So don't worry about that. You just keep checking your email. Also, for the presentation, please feel free to open up the chat window at the very top of your screen, the conversation icon. And if you'd like, you can ask a question, put it into the chat, and we'll either respond as we go through the webinar to the question, or save it to the very end for our Q&A session. All right, we got a good number of people in. Let's go ahead and get going forward. By way of introduction, I'm Bobby Young, Client Services Director, and I'm joined today by Ken Brown and Tracy Fesley, principals here at HdL. We all work on HdL's California sales tax team and meet with clients each quarter to review and analyze your sales tax revenue and that which comes into all of your local communities. Got a little trigger finger there. A little bit about HdL for those that may be not yet familiar with us. We've been serving here in California for well over 40 years. So blessed to work with so many agencies. Not only here, though, in California, we now span coast to coast throughout the country, and even more so blessed to work with over 900 local municipalities, and truly grateful to maintain a 99% client retention rate. So thank you so much for allowing us to serve you and your communities. Let's jump in. Third quarter results, what we're all waiting to see. Reminder, third quarter calendar year, July, August, September time period. Here's what we got. Positive 1.9% growth. Come on. There we go. Positive 1.9% growth overall. It far exceeded our expectations when we just presented to you in September. We were expecting some growth, and we'd seen that. You're gonna see it on some slides coming up. We expected some growth, just a little bit more moderate, right? We saw some dynamic categories. Two categories in particular: business and industry, and the countywide use tax pool. Tracy's got the she's got the gratefulness today. She gets to present to you later on business and industry. Both these categories that saw really strong growth. She'll give you all the reasons there. Ken Brown drew the short straw. He's going to be talking about building construction and fuel and service stations, two major categories where we kind of saw this continual slowdown, pullback, especially during the summer periods. For us, we don't just look at this as kind of in a little bit of a bubble. We expanded and kind of also look at 2Q, the reminder of the April, May, June, combine that now with 3Q and what happened during our summer period. We were expecting to see some growth in I would say, in one of these categories, building construction, and we just didn't see it. Ken Brown's got that for you coming up. When we sat around just a few weeks ago, got the data, and really tried to put our heads together, our entire team of principals here at HdL, these were our major considerations. You see it here right at the very top, kind of in a red/orange category, refinery capacity, really leaning into the fuel and service stations. Like I said, Ken Brown's got that coming up for you. Starting to temper off. If we reflect back to the beginning of the year, we had major concerns, especially with trade policy and tariffs. We're starting to change that into a little bit lighter color, just because as I think we've all heard and listened, not as much fear related to tariffs, whether those that have been enacted or haven't. And it's just starting to temper a little bit. Labor market conditions and unemployment are always a big concern. And I think that also then leads into what we're hearing a lot more about: a K-shaped economy. For those unaware, a K-shaped economy really focuses on the two pieces of that K shape, one going up dramatically and one going down dramatically. We do all know, part of our economy that continues to expand. And if you look of those that are more green, especially business investment and the AI bubble that has helped, our stock market, national stock market, continue to drive forward, allowing investors and maybe even high income earners really accelerate faster as far as spending power than those that are on kind of more of the lower end or the downside of the K. A little bit more lower income folks, price sensitive, those sensitive to inflation, and also unemployment, maybe a little bit more heavily impacted there. So we've got, that's when we hear about K-shaped economy on a national level, that's kind of, what you can refer back to. Then you get into the green areas, and as I just mentioned, with business investment, AI, and that continues to help move along California spending, and that which the results you just saw. But as I'll talk about here in just a couple of minutes is interest rates, and we've seen continual reduction there. Obviously, much more to listen for in 2026. So these were our big considerations as we talked about and got data. Let's dig in a little bit. Some of those areas that we kind of focused on, or were focused on back at the beginning of the year, and maybe not so much right now. When we think about tariffs, right? And when we listen to national news and well, yeah, the economy really hasn't seen the impact of tariffs yet. It's partially due to what you see on the screen here. This large spike in imports back at the beginning of the calendar year was a little bit more of stockpiling and merchants trying to get ahead of tariffs and get materials in before prices went up. Now you can see, as far as imports went all through the summer, got right back on track with where they were in 23 and 24. So allowing for the materials and goods that folks are buying now to maybe not be as price sensitive to tariffs, just because the goods were already here. Is there more to come? Gosh, we're all waiting to see, especially when we get to the fourth quarter holiday results. Is on our mind, but then we're already into 2026. Let's definitely more to come here. Goods and services, how has CPI been trending? You can see the three lines here. Top line services, CPI related to core services, core CPI overall, and what we've seen here in 25, and no doubt we have felt, is a continual rise out of core CPI around goods. So more to come there, and it just getting back from the depths post pandemic and the dramatic rise in CPI that we saw there. A little bit more data or visuals regarding spending. The red lines, both solid and checkered here or dotted, relate to retail spending. The blue lines are on service spending. And so then the solid lines relate to spending, whereas the dotted lines relate to transactions. What you see here is on the services side, we see service spending continue to increase and also service transactions. So as transactions have increased, we've seen spending increase a little bit more as it relates to, and we kind of noted here, folks trading for lower ticket services. So both of the lines continue to go up, whereas we're seeing a gap as it's been, and this is over the summer period as we look to the right side of the screen, the right side of the chart here, where the retail spending continues to go up, but we don't see the number of transactions, meaning folks are paying more for less. As we know it, and we translate it into CPI, inflation, and kind of the growth there. This is another chart to kind of confirm, yep, we are paying more for less transactions, but it still means sales tax revenue growth, which is along the positive lines. Savings and disposable income, kind of always checking this one to see where we are. Third quarter was when we chipped away and slightly decreased under, and this is on a national basis, chipped under 5%. Folks digging into personal savings a little bit more. Not for the fear standpoint, I don't think we're there yet. As we've talked about it, still feel like there's money for consumers to spend, but starting to dip into savings. I think this is, in light of probably what we're going to be talking about next, which is interest rates. Hopefully allowing folks to either have access to more money, available money with a lower interest rate, to then not have to dip into their savings as much, or just inspire some overall growth. Here, kind of displaying interest rates and where we've come from, the high interest rate environment back in 2020 to 2023. 2024, we started to see some reductions from those high points, but then late here in 25, finally kind of got what we had been hoping for so long. If you're a longtime viewer of the webinar, I've been on this one. Yes, we think interest rates need to come down. They should come down. We're starting to see that now. Is it going to carry into 2026? By all accounts, yes, we should see some further reductions. The end of this month, the end of January, is the next time that the committee will be getting together to reevaluate the Fed funds rate, and all expectations are probably another 0.25%. We see this as, yes, a little bit more of a short-term positive when we think through the forecast, simply because, yes, in the near term, it should allow access to more cash, more equity, lower financing rates for things like automobiles, to allow consumers to spend more, thereby increase sales tax. If interest rates, and we'll kind of start to talk about this now and just kind of acknowledge it, if interest rates come down dramatically at any point in 2026, it will likely cause a bit more of a bubble. So we'll see the growth, but then on the back end of it, expect to see a slowing down and maybe even a dramatic slowing down. So more to come there, and why we're so focused on watching what interest rates are doing. Here's the trends over time, historically to the left here on the slide. As we grind it on, and we're hopefully, knock on wood, we are done, at least we're forecasting that we're done talking about negatives and declines, because now we've been on this period of 3 quarters, all of 2025 so far to date, seeing positive growth. And you can obviously see here on the screen in the coming periods, expecting that to continue inching along. It's not yet back to normal historical growth, but it is positive, especially as it relates back to where we've come from. And at this point, let's, really quickly see, I kind of highlight them here on a fiscal year basis, right? Because we're getting ready, we're currently in the process of updating all of our clients' 3-year forecast, sales tax forecast. So current fiscal year, 1.7% growth statewide, and then that carrying into 26, 27, 2.6, and I'll talk about it a little bit later at the back end, but that's still lagging from our normal historical growth. So positive, but not yet back to where we've been or normally are. And at this point, I'll turn it over to Ken Brown.
Thank you so much, Bobby. Appreciate that. And let's get into the major industry groups. Let's dig into autos. And throughout my presentation today, I'm going to be talking quite a bit about affordability. And affordability is certainly a buzzword we've been hearing a lot about in the news. And that certainly is a concern here for autos. Affordability, as you can see here, for new vehicle pricing reached pretty low levels coming out of the pandemic due to supply chain shortages and a whole host of other issues. The average price for a vehicle in the United States broached $50,000 for the first time right around tail end of 2022. And so if you see over here on the right, you can see this is a graph of affordability related to the purchase of autos that's not just denominated by price, but also financing rates and wages, and really reached unaffordable levels. And, you know, prices have stabilized, but they've never really come down from where they were in the pandemic. They're still above long-term averages here at 36.3 as interest rates have come down a little bit, and also as wages have. So this is really creating a challenging backdrop for the market. And it's one of the big reasons we've been working through a big sort of backlog over the last couple of years where things have been very sluggish. Now, turning to an event very important to the auto market that just occurred here at the end of the last quarter, September 30th, 2025, we had the expiration of the $7,500 tax credit for electric car vehicles. And so this is important because I think it's a big reason why we actually saw a little bit of a positive bump up in tax proceeds for autos in the last third quarter. We were up about, I think, 0.9%, which was a little bit better than the flat result we had been projecting, and certainly better than the negative 0.9% result that we saw the quarter before. But real quick, as an interesting diversion, interestingly enough, didn't seem to help Tesla too much. The California New Car Dealers Association, they just reported in their quarterly outlook that Tesla vehicle registrations in the state of California were actually down 9% in the third quarter, despite the expiration of that federal tax credit. And so it didn't help them too much, but certainly it did seem to help a lot of non-Tesla electric car sales. We did see boosts in GM and Ford. However, one thing that's important for our forecast looking forward is that there does appear to have been a substantial pull forward of demand, because we are hearing that October and November industry-wide sales selling rates are lower. So that's something important that we're taking into consideration. Okay, so where does it all fit together in terms of the forecasting and the outlook? U.S. light vehicle sales 2025 ended the year a little bit better than most analysts have projected at the beginning of the year. And I think that was certainly boosted by the one-time event of the electric car tax credit expiration, but it was also boosted by another one-time event, and that was the implementation of the tariffs back in April. And with that, there was also a host of shoppers rushing out to buy vehicles at that point in time, probably pulling forward demand from future years. So we had a couple of one-time events that did boost the market. Now, affordability is a real concern, as we talked about earlier, and most analysts are projecting that we're going to be kind of range-bound for the next couple of years here, between 15 and 16 million units per year sold in the United States, which is a little bit below where we were before the pandemic, here at around 17 million. And so most forecasts are looking, they do vary, but most that I've seen are looking for maybe about a 2 to 3% dip in unit vehicle volume. But that doesn't necessarily equate to sales tax proceeds, because we are still likely to see some increasing prices with inflation over time. And so our outlook for the next year is, while muted, is still positive. Now, that is contrasted with next quarter. We do believe, with the expiration of the tax credits, that we probably will see a little bit of a dip next quarter, about 1%, with that pull forward in demand. But then we'll start to see a slow normalization of the market. And with interest rates dropping over time, wages growing, we do expect to see a return to normalization over time. Now, turning to the fuel and service station outlook, there's a whole host of factors that we look at, and I'm going to talk here about a couple in depth, with the most prominent being, of course, supply and demand as determinant of pricing, and also revenue that you would receive at the pumps from your local gasoline stations. And so first, this two graphs here on this one slide really tells the whole story, I think, in terms of supply and demand, two crucial components. And here on the left, you see world oil production. And the key point here to know is that the world oil market is very well supplied. And a large part of the thanks for that is the United States here with fracking technology. I think I read between 21 and 24, you can see the sharp uptick, a 20% boost in production in United States crude oil. So the oil market is well supplied. But what about demand? And so that's where the graph over here on the right comes in. Most forecasts for GDP in terms of global growth are coming down a little bit for 2026. You see that for the United States, you see that for China, and many other major world economies. So what does that all mean? Well, it means we've got lower fuel prices, lower oil prices. We are down here to about $56 a barrel. And if you look back in time compared to history, that is about as low as we've seen since around the pandemic. And this isn't even adjusted for inflation. So if you adjusted that in real terms, wow, it would be even more of a pronounced impact. All right, but what about the wild card we've been hearing in the news about Venezuela? To address that really quickly, yes, Venezuela has the world's largest proven oil reserves. However, it is a very small producer, only about 1 million barrels a day, far lower than any of these other producers that are listed here on the graph. So it is not an immediate impact to our forecasting. And in fact, Venezuelan crude is heavy crude, and it is going to take substantial investment, substantial time to increase production from Venezuela. So not any sort of near-term impact on our forecast, but something that we are watching. But what is a big impact? This is something, a slide that you've seen from us, I think, for at least a year, if not longer. We've been talking about this. We've been seeing this coming for a long time, and here it is. It has arrived. This is the closure of the California refineries. Refineries being very important because that's what turns the crude oil products into the gasoline in California that we use to fuel our vehicles. And we just had the Phillips 76 closed down here at the end of last year, and we still got the Benicia and the Wilmington refineries basically potentially closing here in 2026. So the governor is working to mitigate those potential impacts, but it is something that we are watching closely. And in fact, we have seen a little uptick in pricing here just since the end of last quarter after 3 consecutive quarters here of decline. So we are starting to see an impact there in terms of pricing. And so our outlook overall for the fuel and oil industry sector here in terms of tax receipts is higher, gradually increasing prices from the recent levels, and of course, heavily influenced by these potential refinery closures. Now, building and construction. The housing market has just been frozen in place for some time here as we have reached very elevated prices. Very few people are moving or putting their homes on the market. Why is no one moving? Well, there's a couple answers, very complex issue, but 2 of the big ones are right here on this chart. One of them being that people are locked into great mortgages. We've got now 54% of mortgages at or below 4%. So why would you move if then you would have to pay the prevailing rate, which right now is around 6%? So one big impediment to mobility in terms of the housing market, but a second major one, capital gains. The $500,000 capital gains exclusion on the sale of a new home, if you're married and filing jointly, hasn't been increased, I think, in around 30 years. And we're at a point now where I've read 33% of California homes exceed that 500K threshold and would be subject to capital gains if selling. And it's even worse in many of these coastal districts here. You see San Jose at 71%. And then on top of all that, you've got Prop 13, right? Which is another impediment in keeping prices lower. So a whole bunch of factors in keeping the market frozen. And you can see here over the last 3 years, this is national real pricing for homes, hardly any movement at all in terms of pricing. That is, though, with time moving on, slowly starting to increase affordability a little bit, but many economists believe that it's going to take potentially many years to get back to a more affordable level. And so it'll require time, wage growth, interest rate reductions. And so we'll wait and see how that plays out. There is some efforts at the state level to try and improve affordability with, for example, AB 130, Senate Bill 131, as we have a lot of trying to streamline project approvals. But we also have pricing pressures with labor and supply costs also increasing. So basically, we are projecting for this next upcoming year another small decrease in sales tax revenue from the sale of construction materials. But eventually, however, we expect that with time, interest rate reductions will be one catalyst helping to slowly unfreeze the market over time in fiscal year 26, 27, and beyond. My final category is the food and drug sector, and it is an interesting sector, but relatively small, as we always mention in terms of statewide taxable proceeds. It was down this quarter. I think the biggest reason, as you can see here, was drugstore closures. We've seen a lot of right sizing of drugstore closure chains. with 10.5% dip in that subsector. But even grocery stores themselves were down. And I think one of the interesting aspects of this is that just like we saw in brick and mortar retailers that were confounded or have been confounded by years of competition from online, we also have similar sort of dynamic at play here with grocery stores, where you've got not only Target, which is in the general consumer goods category, Costco, Walmart, and others moving in to increasing degrees, but we also have Dollar Tree, and now even retailers like 7-Eleven. I hear that 7-Eleven is upping their game here in the United States, planning to revamp a bunch of stores, open up stores similar to their world famous outlets in Japan that have some great food offerings there. And then, of course, the online options, a lot of evolving online options, including Thrive Market, Misfits Market, and many others beyond the traditional Instacart that we've all grown familiar with. The one bit of good news here in the sector this quarter is that we did see our second quarterly year-over-year increase in tax revenue from cannabis sales after a long period of decline. So that was positive, but unfortunately not enough to lift up the overall sector. As you can see in 3Q25, despite that increase in cannabis, we were still down about 2%. And so given the pressures in the sector, we are forecasting continued modest declines over the next year or so, similar to what we've seen for the last couple years. So kind of a consolidation here in this industry, very similar to like what we saw in autos and also now in building. So with that, I am really pleased to turn the presentation over to my colleague, Tracy.
All right, thank you, Ken. Let me slide and we'll get going. And I am going to jump right into looking at the remaining sales tax groups. And I'm going to start with general consumer goods, otherwise known as brick and mortar retail. But first, before we get into the details of general consumer goods, let's look at the total retail picture, which is about 29% of the statewide local tax over the last 4 years. General consumer goods accounts for 57% of the overall retail, and online sales about 43%. The graph on the screen, the blue trend line here represents online sales. This includes direct payments to agencies with fulfillment centers and indirect e-commerce sales that are allocated through the countywide use tax pools. As you can see, online sales have increased pretty dramatically over the last 2 years. It's a bit on a bender here. The green trend line indicates brick and mortar down here, and retail sales, brick and mortar retail sales, which have been declining. Well, until this quarter, we saw a bit of a blip in third quarter 25. I'll talk about that in a moment. First increase in quite a while. Total retail is this gold trend line here, very positive. The data emphasizes that people are still spending. Bobby kind of alluded to this in his intro, but they're picking and choosing where. Folks are spending online a little bit more than they are in brick and mortar stores. So when we talk about general consumer goods and its basic decline over the last couple of years, for the most part, it's only part of the retail story. Overall retail, when you consider e-commerce, has actually been up in the last 5 of 6 quarters. Looking at brick and mortar entirely, as I mentioned, we see an increase in third quarter of 25, just under 1%, following 2 years of decline. Part of this growth story this quarter is related to some new businesses that have boosted comparative sales, some of which in the jewelry store and shoe store sectors. These are business types within general consumer goods. Consumers continue to seek value, and much of the data mirrors that. Those with resources are spending, those with fewer resources are pulling back and being selective in their spending. This is part of that K-shaped economy that Bobby referenced. Family apparel and the variety stores kind of fall into that value-based economy or kind of group of stores. So do discount department stores. These get diluted a little bit because our discount department stores, many of them include fuel. So the decrease in fuel costs that Ken mentioned is playing into this growth number here because that's kind of bringing down the overall results. But the bottom line is consumers are still spending in a lot of these categories, but they're being very selective where they are. Some of the need to or want to categories like sporting goods and bike stores, we're continuing to see declines. We look to a lot of different resources when we're considering growth in our forecast for retailers, one of which is retailer guidance. This chart is just really showing in the green those private sector companies that are increasing their outlook going forward compared to a year ago, and those that are unchanged. So this is not indicating positives and negatives on the balance sheet, it's just their outlook. But it helps us as we're creating our outlook as well. So looking forward, the takeaway here for general consumer goods is moderate growth. As I said, we're coming off of 2 years of declines, both in fiscal years 23-24 and 24-25, just under 2% drop each year. This year, we're looking at a little bit of growth, 1%, and next year, 1%. I would call this almost flat, but just very moderate growth in the brick and mortar retail group. All right, let's jump into the pools. The graph on the screen is identifying the major industry groups in the countywide use tax pools. I'll just highlight these very quickly. Autos and transportation tends to grab Department of Motor Vehicle third-party transactions. Building and construction, a lot of this is a one-time use tax, but there's also some online sales here as well. Restaurants and hotels, kind of a funny category in the pools. A lot of this is online delivery services. The two biggest groups in this in the pools are business and industry and general consumer goods. Business and industry grew by 4.7%, and general consumer goods grew by 6.5% in the pools this quarter compared to a year ago. All right, these are the top business types in the pools, not the groups. We just looked at the overall groups. These are the business types, kind of the subsectors. The largest percentage change included or is reflected in electronics appliance stores. So they're the smallest group at 4% of the total. They grew almost 33%. A large part of that is related to some statewide audits that transferred money out of direct allocation into the pools. In third quarter, we'll see it again in fourth quarter, and this is reflecting some of that growth there. The largest sector here is marketplace sellers. They are 16% of the total. They also grew. These are retailers like Etsy and Wayfair and Amazon. So again, this is e-commerce really growing a part of the countywide pools. Again, the pools overall grew 6.2% this quarter compared to a year ago. So fairly strong growth. Some considerations in our outlook. E-commerce, you're going to hear me say that word repeatedly. I apologize. I'm on repeat here. I can't help it. Bobby is laughing because he's like, don't say it so much. I can't. I can't because it's a big part of the story. So digital sales and fulfillment centers in California continue to be a big revenue generating aspect. And then, of course, we're buying stuff on our phones now. And that is mobile shopping. It used to be we were buying stuff on our laptops, but we're migrating. Now it's on our phones. Investment in technology is a big consideration. Growth in business services, I'll talk about that in a moment. Kind of B2B. technological infrastructure improvement and maintenance, and of course AI. We can't get out of here without talking about AI. Big investment there when it comes to e-commerce in particular. And then just from an economic outlook for the pool, consumers are spending, but again, going back to that K-shaped economy, heavily reliant on higher wage earners. Those with money are spending. Those with less resources are either pulling back or being more selective in their spending. And then lastly, we expect e-commerce in the pools and outside of the pools to grow and exceed 20% of retail sales by next year. All right, the forecast. Growth in the pool is anticipated to continue. We had a dip in the pool in 23-24, growth in this last fiscal year in 24-25, big jump in 25-26. You can see the biggest quarters here are this quarter, boost in third quarter 25, anticipated in fourth quarter, again related to some audit shifts and also just spending. I mean, these are folks still spending money. And then the outlook for the pools, pretty solid, 3% growth quarter year over year. All right. Somewhat linked to pools is business and industry. This is a really diverse group, 21 distinct sectors. Overall, business and industry grew 5% in the third quarter, much of it related to fulfillment centers. I'll talk about that a little bit more in a moment. The graph highlights some of the top business gains and losses this quarter. Business services was a big gain. This is B2B transactions. These do fluctuate from quarter to quarter. And one of the biggest losses was in warehouse farm construction equipment, down 9%. This is a sector that's been struggling. Some of the bigger taxpayers like Caterpillar, Kubota, John Deere, all posting declines on their balance sheets. Their outlook is down. Capital spending is a little bit, is down. Capital difficult to come by, and that's impacting this sector here as well. The two kind of biggest changes here in this bottom box, fulfillment centers. The change is that the growth is not as large, but is very impactful because fulfillment centers are 30% of the overall group for business and industry. So this is all e-commerce related, and we saw about 12% growth here. Energy utilities, they are 3% of the total group, so much smaller. However, their growth was a whopping 75%. Now, this is incredibly volatile and an area that we struggle with here at HdL when we're trying to do our forecast. This is driven by projects throughout the state related to solar, battery storage, anything energy, heating and cooling is captured here in energy utilities. And this is up and down this quarter, big increase. And this is coming off a year of big decreases. So definitely seeing a lot of volatility this quarter in this group. Industry trends in business and industry. As I mentioned, this is a really diverse group. There's a lot of different sectors driving the numbers. Fulfillment centers, since they're 30% of the whole group, this is the biggie, growth at almost 12% this quarter. We think this is going to keep growing 5 to 6% in the upcoming quarters. Industrial sectors, fairly large groups as well. The ISM Manufacturing Index continues to contract. This is an index we lean into when looking at both heavy and light industry. Most of the outlook there is in the red. A lot of challenges. Medical biotechnology, another strong group. We saw increase this quarter. However, it's, we're not anticipating a big jump here. There's a lot of headwinds here as well. Funding is hard to secure. AI is a big part of medical biotechnology right now. It's a strong sector in California. We have a number of life sciences biotechnology clusters in the state. Definitely a lot of strategic partnerships, kind of helping sustain things right now. And again, a lot of uncertainty in this industry as a whole, nationwide as well as within California. Agriculture, we all know this is strong in California. This is a big part of who we are in California, particularly in the Central Valley. A lot of challenges. Labor challenges for a lot of reasons, international trade and tariff policies impacting the California markets, both in tree nuts, wine exports, row crops. All of these areas are struggling a little bit, well, a lot of it right now with regard to growth. So forecasting a little bit of downward trend in this industry right now. Okay, as a whole, business and industry forecast, still expecting growth. The last 2 fiscal years, we saw just under 2%, anticipating a little over 3% this year, and then going into the looking forward about 4% growth in the out quarters. The bottom line here is e-commerce is really pushing this forecast into the positive. All right, let's switch gears entirely and look at restaurants and hotels. Yeah, could be more different, right? But a really important area within sales tax in California, restaurants in particular, the largest part of this group. As you can see, casual dining, 4% of the total group, a little bit of growth here. So we're still seeing casual dining grow. However, rounding out the top 3, quick service and fast casual are declining. Fine dining is declining as well. They're much smaller, and they have been declining for a little bit. Consumers are seeking value, and they're tending to land in the casual dining group versus the other dining sectors. Why? Well, I'll talk about that in just a moment. The why is because of menu prices. They continue to increase. So up 3.7% over the past year. These graphs are from the National Restaurant Association. They really substantiate what we're seeing in our California sales tax data with menu prices and kind of where the numbers are going. So up 3.7%. Folks are choosing casual dining over the other dining sectors with these menu prices high. I mean, candidly, if I'm going to be paying effectively the same price for a fast food meal, might as well go and visit a casual dining eatery, enjoy the experience of sitting down and eating my food versus eating it in my car. So that is just part of that industrial trend right now. I'm backing up just a little bit, looking at both hotels and the impact of tourism on hotels and restaurants, seeing a softer tourism spending in our outlook right now. The graph is a graph, again, from the Restaurant Association, 47%. Lower than normal sales from travelers and visitors in 2025. That really, again, supports the data that we have, where we did not see a big second quarter and third quarter tourism boost. These are the busy spring and summer months, and it was fairly flat, if not a little low. So these are areas within the restaurants, hotels group that we're still seeing. We have room for growth, we'll put it that way, as we move forward. Influential restaurant trends, really quick. Affordability, I've talked about that. People like Yelp in their search, their top searches are cheap eats, meal deal, value meal. People are looking for where they get the most for their buck. And they're also ordering their food on their phone. So a lot of digital integration here. This is very similar to e-commerce. I mean, this is e-commerce, right? This is e-commerce for food instead of retail. Labor is a headwind for the restaurant industry as well. So 62 to 70% of operators report staffing shortfalls. We're seeing wage hikes in California through legislative effort that have in some cases resulted in job losses. So this is just an area that restaurateurs continue to struggle in. Okay, looking at the forecast. Third quarter 25 came in at 0.8%, just under 1%, very similar, I'm sorry, right here, 0.7%. Let me slow down. Just under 1%. Looking toward next quarter, 0.8%. Again, low, and we see a bump in first quarter of 26. This is in part because we are anticipating some recovery from the Los Angeles fires, where we saw a big hit in first quarter of 25. So this is why you see this bump here. Overall, it's still really low growth in the industry, about 1.7%. In this fiscal year, 25-26, anticipating 2.8% next year. All right, handing it back to Bobby to wrap it all up.
Wonderful. Thank you, Tracy. Great job. Take a breath. Both yourself and Ken did a fabulous job there of going in deep. Hopefully, as we all got to listen to, we've kind of explained, what happened, and also what we think is to come. There's hopefully now, as we've painted the whole picture, you can see we've got, as I mentioned at the front end, we've got 1.7% growth expected statewide here for 25-26. A little bit of room for growth, right? As both Ken and Tracy spoke about, whether it be interest rates, whether it be tourism, pricing, it feels like consumers obviously have had room to spend. We saw that, the last 3 quarters, we've seen growth over prior year. Here, putting in, the prior years, fiscal years into perspective, and a reminder of, where we're coming from. A big drop, a 1% decrease, softened only 0.5%, 24-25, now starting to see that positive growth. And then when we look towards the out years, and if any of you are thinking about that, hey, I got to update my 5-year outlook, what does that look like? You see here a little bit more of the 3 to 3.5, 3.3 to even 3.5% would be more of a return to normal historical growth, which I've mentioned many times and used that phrase. Tracy, you talked about me not wanting to hear e-commerce. You guys don't want to hear normal historical growth, but hey, we're on that track. Things are positive, irrespective of, kind of some of the ancillary or the in-betweens. Maybe some sectors aren't doing as good, but we're seeing that growth. And I would say, even as Tracy was, talking about the pools and the future outlook on pools, is like we could be conservative there, depending on what we as consumers do over these next couple of years. So that growth back up to 3% doesn't seem unlikely or untangible, except how we get there. And I think that's the story that's still to come, and one that we're looking forward to telling everybody. If it is by way of a dramatic drop in interest rates, that could spell a quicker turnaround and maybe not see so much in years 4 and 5 growth, because we as consumers will reflect back on what happened, as you see on the screen, FY 21, 22, and 22, 23, and then the results there in the following 2 years. So hopefully this has helped you put it all together. I'll leave you with a reminder that over the next 2 months, January and February, our entire team is going to be working so hard on updating your forecast. We do that at this period by default. We will update your forecast also next quarter. The next set of data we get, that'll be fourth quarter. As a reminder of timing there, we won't get fourth quarter data until the beginning of March. Okay, and we'll be dissecting it, looking to put all this together for you in March, and then meet with you in April, May. But coming up January, February, look for your meeting notices to come either from Mary or Anthony, who do a fabulous job of scheduling all of our client meetings, to be able to communicate with you what is your city expected to get. Obviously, we've been talking about the statewide here. So as we kind of wrap up, won't be a surprise for many local agencies to see some positive expected growth, and then just kind of look to see how your businesses are doing and performing. So that is our forecast. We do have the Q&A coming up. We're getting some questions coming through the chat. So let's transition over right now. We've got a few minutes. We're getting pretty good at this. We got 8 to 10 minutes to leave for Q&A. So let's talk about one of the first items that came up in the chat. Ken Brown, you want to go ahead and take this? We had a question. Please share how Prop 13 keeps prices lower. And I think Vincent maybe misheard what you mentioned there on Prop 13.
Yeah, my reference there, what I was trying to refer to in terms of the reference to Prop 13 was essentially it was just another one of the many myriad of factors that's gumming up the whole housing market in terms of people moving. We've got high prices. We've got interest rates that, while lower now compared to a couple years ago, are still far higher than they were when a lot of people bought in. And then on top of that, you got the capital gains, you've got Prop 13, because if you buy into a house and you've been there for a while, your property taxes can only go up, 2%. So you've got a pretty good deal. So it's just another impediment to moving, less activity overall.
Wonderful. Yeah, thanks for the clarification there. We also got a question in the chat. Is the Super Bowl and World Cup both major events coming up here in 2026? Super Bowl is going to be in Santa Clara, with the World Cup during the as we've looked at the schedule, it's during the month of June, maybe even a little carryover into July, but all throughout the state. Are those factored into the hotel forecast? Not so specifically on a statewide basis. And the reasons are, one is we've had them in the past. The Super Bowl in 26 will also compare, as you saw on Tracy's forecast, what happened a year ago in the first quarter were the fires in LA. And so on a statewide basis, those two are going to kind of help balance each other out. When we come down to the local level, and for agencies that may be hosting the World Cup pre-events or individual matches, we will be addressing, hey, what do we think the temporary bump's going to be? And this is also in anticipation of, we're talking with clients right now about 2028 already, and we have the Olympic Games coming to the Southern California region, not just LA, it's going to be all around the region. And so that is where we take, yes, what you've seen statewide, we're bringing that down to the local level, really having tangible conversations about how your local community could be impacted by those big events. So it doesn't show so specifically in the statewide because, one, we're a big state and gosh, there continues to be a ton of spending anyway, but we will be talking at the local level when those events come in. Let's see, another question that we got. While the tariffs did not have as much of an impact on the prior quarter, did immigration enforcement have an economic effect in our state? And do we think that has any impact on the uptick in online trends as well? It's a great question. A whole lot that goes into that. On a statewide basis, does immigration enforcement, have an economic impact? Not so much on a statewide basis. I would tell you absolutely on a local enforcement level, and we've had those conversations with communities that had, a bigger presence and how their communities have responded. And I absolutely would agree with Erica there. Would it have an impact on online trends as well? Absolutely. Folks not wanting to go out for the sake of interactions, yeah, they'll stay in and buy, and that'll carry over not just to general consumer goods, but as Tracy mentioned, even over on food and online food delivery. So it isn't in there in any specific way. We just know that, yes, if somebody is going to buy goods online versus in store, it'll move within the categories, but it's still purchasing. If people are going to buy food and have it delivered to their house versus going into a restaurant, it's still a sale. And so that's where I would say, yeah, it's included because we still feel like people are going to buy regardless of where they buy from. Let's see. Can we get an electric version of the statewide report? Yes, it'll be posted on our website, and all registered participants will receive an email notification when both the video copy and the slide deck are posted there. So be on the lookout. And Tracy, it looks like you might have got a question in the chat as well. What factor, if any, does inflation in the food away from home component of CPI impact restaurants forecast?
Yeah, thank you for the question, Mark. It's a good one. What I will say is I don't have a specific metric with regard to inflation impacting, food away from home and how that dovetails into the restaurant growth, but it's part of the consideration. So when we're looking at growth in restaurants and hotels as a total sales tax group, we're considering that. It's just one of several considerations within our forecasting.
Yeah, great. One last comment, it looks like, so in the chat, we got the question, I answered it, of where the sales tax goes from online, simplifying it, where the sales tax goes from online sales. And it depends on where the goods were located at the time we as consumers bought them. If they're in state already, the sales tax will go to the fulfillment center where the goods were located at the time of purchase. If the goods come from out of state, then the sales tax dollars go into the county-wide use tax pool of the county where the goods were shipped into from out of state. And then there is talk about changing kind of this law and how sales tax gets allocated. So the question was, do you have any updates on whether this might happen, and if so, when? No updates to speak of. There is continual discussions with the League of California Cities and what was formerly known as the City Manager Working Group to come up with a equitable suggestion or presentation to how you might change the law. And I would tell you there has been no updates specifically from that group or that process. It I think was always noted it was going to be a long one, and we're kind of tracking along with it. We are at the table helping with the conversation, and we'll provide updates if any when they come out. And also, Thomas, you joined late, but does HdL have a stance on percentage chance of a recession in 26 or 27? I'll give you a credit. You came in late. If you saw my last slide here, if I go back to it, I think you'll see that chance in those two fiscal years right now sits at about 0. We're actually expecting growth here in what is 25, 26, 26, 27. And with all information that we have in front of us and all expectations, I wouldn't expect it to see it in 27, 28. And kind of dovetailing onto my last comment when I mentioned it, is if interest rates drive higher, or if the Fed drives interest rates lower, causing sales tax and spending to dramatically rise, it'll probably happen during calendar year 26. We would then probably start to look at what is now fiscal year 27, 28 as, that's the one to really watch for sensitive declines or changes in sales tax revenue. So,
and if I could just add on to that, it's something that we talk about as a team all the time, and we're always debating that in our meetings and just amongst each other. And just took a look. Polymarket is one of those indicators, the betting website. Only a 24% chance of recession right now in 2026. They don't have one yet for 2027. There's always a chance, right? There's always a chance, but the odds right now in the near term are fairly low.
Yeah. Wonderful. Here we are at the end of the presentation, hopefully keeping everybody right on time with the middle of the day. Looking forward to seeing everybody. As a reminder, whether it be during our quarterly meetings with you in February, as a reminder, we've got the City Managers Conference that'll be happening in Napa, and also CSMFO Conference that'll be happening in Palm Springs. Hopefully myself or our team get a chance to see you face to face, speak with you, and communicate about sales tax. That's what we love to do. In the meantime, enjoy the new year. I hope everybody is having a wonderful day, week, rest of the month. Let us know if you have any questions as we move forward. Thank you so much for your time today.